So glad everyone's here. This is amazing. What a great turnout. Thank you for joining us. So we are here, ironically, to cut through the noise, as it's very noisy. Thank you, guys. Ironically, we are here to cut through the noise. Welcome to the panel, Cut Through the Noise, How to Get Your AI Startup Funded in a Crowded Market. Quick show of hands, actually. Who here is an AI founder right now? Okay, amazing. So we know our audience here. I keep your hands up. So who is seed stage and earlier? Okay. How about Series A and later? Okay. All right. Oh, welcome. So we're here with an audience of mostly seed stage founders, and this is great. So my name is Carl Fudge. I lead the team at Presentation Mode. We are a creative agency that works with founders every day to build pitch decks that raise tens of millions. And we're here because we're noticing this flood of AI pitches with many pitches sounding very similar. AI for X, AI for Y. So we want to help these founders cut through the noise and create an AI pitch that really resonates with investors like the ones that we have here today. And that's what the panel is going to be about. So joining me, we have an amazing group of panelists. On my far right, in the green, is Renata Quintini. Renata is the founder and the general partner of Renegade Ventures and comes from Lux Capital and Panelists as well. She's no stranger to funding unicorns. Next to her, we have Leshika Samarasinghe. Leshika, I got it, is the founder and general partner of Twine. Started her career at Google, so she's no stranger to explosively growing companies. And then finally, we have Emily Libresco. Emily is from Lerer Hippeau, the New York City's premier seed stage investment firm. Emily has a background actually in English lit, so she's no stranger to really good narratives. So thank you all for being here. Really amazing panel. Let's start with you, Renata. Can you give us, first of all, a lay of the land? So where are we in terms of VC fundraising right now? How much of that fundraising is going to AI startups? Is it still as hot as it has been? Is it getting hotter? Is it cooling off and going to other sectors? Just give us a lay of the land.
I think there is expectation that net new companies are AI first companies for whatever it is that they're doing. So the trend is VC dollars going up and up. After AI, traditional business, there's still big parts of the economy that are still on spreadsheet, 30-year-ago software that is still getting started and funded. And the expectation is every company will be an AI company at some point. The lines are blurring. When will that transition be 100%? Unclear, but absolutely, if you're just getting started and you have an AI first story, it's going to be very hard to get funded.
Any builds on that, Leshika?
Yeah, I mean, I think AI certainly cuts across every sector. I do think we're maturing in the hype cycle. I think there's now more questions around areas like durability of revenue, repeatable sales motions. At Twine, we focus on primarily healthcare and industrials. And I think in these sectors that have like massive fragmented data, the opportunity to have AI tools make better sense of all that data is really huge potential. And so I think some of the hype in certain sectors is really warranted. And you're starting to see adoption from legacy players like health systems that were traditionally really stodgy pick up faster than ever before. So I think it's an incredibly time to be building AI tools in these spaces.
Emily, you come from New York, so you're seeing some similar things, maybe some different things as well. Would love to see what you're seeing in New York. Are you seeing mostly AI? And if so, what kind of sectors are you seeing? How hot is it where you are?
Yeah, so Lerer Hippeau is an early stage generalist firm. We look at everything. We do hard tech and deep tech and DevOps and robotics. We also do a lot of consumer, and we've always done a lot of consumer. And certainly in New York, we have that too. And so with those companies, which we're funding aggressively and enthusiastically alongside all of the other AI businesses, we expect to see rigor in terms of operations, using the best AI tools, cutting out superfluous stuff, using slimmer staffs to build all of that. We see all sorts of things in New York, but I will say that we joke that if we are first to see a San Francisco deal, there's some hair on it. We shouldn't be the very first to lay eyes on it unless there's something a little unconventional about it. We funded a drone imaging AI business that is based in Oakland about a year and a half ago. And we were the first to see it because the founder wasn't sort of a native SF fundraising pro, a very technical engineering and stratospheric engineering background. And so if there's something like that, we might get first look. But if we have very first, cleanest look, at an SF deal that isn't a very dear friend of ours or someone we know quite well, there might be something up with it. We're not doing those sorts of deals for the most part.
So go to Leshika first and then you.
I think so. You share a portfolio company. That's an interesting hybrid, but a really fabulous founder and a really interesting AI business.
It's okay for SF Herbs coming in New York deals, but okay. And then yeah, exactly. Series A, pre-seed, seed, Series A. You have the whole spectrum here. Here's seeds.
Question. I think that the real question is, what are products and businesses that need to exist, right? So here we are in this like platform transformation. AI is real and enables things that were not possible before in terms of use case. It enables cost savings, but also what we see is a lot of things that don't solve a problem for their customer or are not real sustainable businesses that are going to have legs to actually get funded. I think on one side you have people like us that see, okay, this transformation is real. This is true platform shift. Let's go look for the things that should exist. But on the other side, there's a lot of supply that is just technology looking for a problem that it's not there. So I think that's the real question.
So I come from design, right? So that's why we're here. This is IDEO. So I worked here for many years, and these are some of the products that my firm works on. And so when you're designing a product, you think about the users of that product, right? So when you design a pitch, you're thinking about the users of the pitch, and that is you all as investors. And what I want to know is what you're solving for in terms of you have LPs, you have targets, you have goals. And what are AI investments doing for you to help achieve those goals? Is it you think that there's the biggest upside? You think it's about the quickest path to return? You think it's about the safest bets? Help us understand why you're investing so much in AI. Maybe Leshika might start with you on this one.
Again, the areas that we're investing in, I think there is just such tremendous opportunity for outsized impact. You can build truly transformational companies. So that's why we're really excited about AI applied to these sectors. I think as far as like what we're looking for, it's the same thing that you're looking for in any pitch, AI or not. It's really like the why you, why now, and how you're going to win. For us at the pre-seed, we really dig into team is the most important thing. But I think that to Renata's point around what problem are you solving? One of the things that we often see missing in pitches is around value proposition. And so you really want to make that crystal clear is how your solution is that much better than others and what pain point you're really solving for your customers. And so that's the thing that, really needs to stand out and what we look for in the companies we're evaluating.
I'll add to that, to your point, Renata, and to yours as well. In a week, I might see 5 companies that are AI for SEO optimization in new search universe. There's one that I think is breaking out. That probably will be different in several months. And so a hearty sense of why you'll win on execution, to your point, and also a hearty sense of who else is doing it and a very sophisticated perspective on why you will be better. It's amazing how many companies I meet that I ask them about competitors and they're like, we're the only people tackling this. I'm like, you're not. I met one yesterday. And so having a really hearty sense of somebody else is working on it here, we're tweaking their approach because we think it makes much more sense the way we're doing it or whatever else. Coming in as quite folks who don't have that sense come off as quite naive to the market. And in this world, that eliminates you sort of immediately.
And on the another variation of there's no one else doing this, one thing that gives me a huge heartburn is when you meet a company that unlocked some technical thing. It's like, oh yeah, we spent all weekend doing this. We have a 4-week lead time. I'm like, that gives me a heartburn. Like, are you comfortable that you're just like 4 weeks ahead of your competition? Or something like that, because technology is just evolving so quickly. People are unlocking new things all the time. And this idea of I'm a first mover, I can run faster than you with, their breath on your neck, I don't know, gives me heartburn.
One thing I wanted to say, by the way, is if you have a question that comes up in this conversation, feel free to submit it here using Slido. There's a QR code and a link. So I just wanted to add that one in. But Emily, back to you. You hear 5 pitches that say we're AI for the same thing. They all kind of sound similar. So what would you wish founders would do? Should they really be focusing on having a differentiated story? Or is it about, hey, that we're AI for this, but look at the things that make us differentiated?
for us, given our stage as well, it comes back to team. I'll give you an example. We did a deal a couple of maybe 6 or 8 weeks ago with an amazing founder, and it's fintech for, agentic commerce stuff. Amazing idea, and he's fabulous. And when we were talking to him and diligencing this, we said, okay, what if Stripe builds this tomorrow? Which is, of course, extremely likely. And they should be doing that. And, he had all sorts of really fabulous and sophisticated perspectives on what he thinks is likely from major players, where he thinks they can be different. But we also know that he is defensible and is really smart and will pivot if something evolves for him, as it's likely to given this stage. And so having enough confidence in an individual and their take on the broader market combined to know that they can weather some of those headwinds, which will come up inevitably, is quite reassuring. And people who really come off as having a thorough grasp of that are differentiated.
Yeah, I think that certainly underscoring the team, and then just also they're building in a space that has positive market dynamics. At the pre-seed, things can change. I mean, things can pivot pretty quickly, but hopefully there's some learnings in the space in general to know how to change your business to adjust accordingly. Because for us especially, I mean, regulations can change, and technology changes, market changes, and so the team has to be able to adapt accordingly. But hopefully, it's a beach where the waves are really big and you can just continue to ride in the right ones.
And for me, so we won't, and actually for AI native companies, we have been doing seed stage companies because we're more stage agnostic. What we're looking for is that moment that you have a product that works and you want to build a company around it. So you're hiring team, you're going through more scalable things, tend to be mostly Series A, but we're actually seeing a lot of seed stage companies kind of hit that moment. But one thing that is non-negotiable for us is customer conversations, because that's what you really understand. What is that product really doing for the end customer? What is the value? What is the customer expectation of success? And, especially when you're dealing with enterprise, a lot of the things that we're hearing are the enterprise customer saying, I want AI. Then you say, okay, what does that mean? They cannot verbalize what does that mean in real practical terms. The other thing that we hear is, oh yeah, I'm trying 3-4 solutions to try to solve a similar problem. I'm going to pick one at some point. I'll pick one. So 3 of them are going to churn. We hear a lot of that. We also hear a lot of, oh yeah, because we're experimenting, I don't care about price. I'm not optimizing for price, but if it goes to a full deployment, I will optimize for price. Or things like, okay, we can experiment with things that are not fully, IT integrated, security, et cetera, but once we go, we're going to have to bring all those teams on board. So I think when you think of enterprise adoption, we are years out. We're not months out from something that is truly scalable. And then when you go and talk to a founder that their idea of product value or scalability doesn't match that reality, that to us is a big disconnect that doesn't fly with us, right? Another question that we tend to ask a lot of founders is around, going back to the English and positioning, ideas of product market. What it is that you tell your customer and what is the scalable message that you have? Because a lot of companies don't have a scalable message because the use case is not scalable yet, right? And one thing that we do, we go to multiple customers and we say, okay, describe what this product does for you. And what we're trying to look for is congruency in answers. But what we're getting is we talk to 5 different people, we get 5 different answers of what the product does for them. So we're okay, how are you going to come up with one unifying message for all these different things, because it's just so early. So talking to customers, but then when we see something that has legs, so for example, we led the Series A of Aerospace Intelligence 5 years ago. They're the best way to think about it is simulations, optimizations for highly, highly complex critical use case networks. First market was airlines. Here, this was this 14 people company in the middle of COVID selling to airlines. You wouldn't think a VC would buy that, right? Because nobody was flying, all this. But then when you talk to, you understand the software stack of airlines, how legacy it was, how they have multiple screens, and the optimization is a human that's trying to take multiple screens and project things forward. Imagine doing that in a networked environment. extremely hard to do. Imagine also cost optimization, all these things. So when you see that, and that there was a founder that really understood a customer pain and could understand, okay, we're starting with dispatcher, we're going to go module 2, module 3, module 4, and then we're going to go to other industries. And they have done that in the past 5 years. So that gives us confidence that this is like an AI product that meets the customer need. You talk to the customer tells you how it's going to expand. Like yesterday I had a customer call from the company that the customer said, oh my God, when I saw this product, I could see it. I could do A with this, B with this, C with this. Like that is exciting to hear. And this is where we over-index. So right now, customer and this, what do you do with the product is huge signal.
Yeah, I think that level of like entrenchment with your customers is really important. We're talking about narrative we've mostly been talking about it in the context of fundraising in your conversations with investors through your story and also your pitch deck. And we talked about the importance of value proposition, seeing how that flows through into your customer-facing materials is also important to make sure that there's that consistency. We'll often ask for that as part of our diligence process, in addition to like ideally customer conversations. But any sales-facing materials that you have that are very clear about that metric, for example, like we help drive top-line sales or increase top-line sales 20%. Like that's very clear about your ROI. That is just incredibly helpful to see the way that you're positioning that value prop and that ROI to customers. And then again, having that be a central part of your narrative for your investors as well.
And showing that you're strategic about the first customers that you're going for, trying to generate deeper relationships with them versus being one of many logos in some tech stack on a slide somewhere. We have a healthcare company that is launching next week, and they have a couple of design partners that are early folks. They're not household names. It's not the Mayo Clinic, but they're extremely deep with these customers. And these are customers with really meaty problems and much less sophisticated tech stacks than a Mayo likely has. So they'll get in there and they'll be able to prove out way more of the thesis. They'll ideally have metrics that are really encouraging from this relationship, and they'll be pivotal to this organization's success and transformation into an AI era, as opposed to being one of many. We'll see a bunch of consumer companies, for example, that, you'll see there's a certain makeup brand I'm thinking of that ends up on a lot of ad and marketing tech websites that we see, anything in that scenario. And it's a big name, and that's exciting. I happen to know the guy who does the early purchasing and piloting of new software businesses at that company. So I know that he is an interesting, pioneer trying things out, and they're very happy to put the logo on. But I know that they're not buying all of these, software businesses or setting up huge profitable contracts. They're trying things, and that's exciting. But we happen to know that the guy at the helm of that is somebody who has huge appetite for it. That's not a deep, sustainable, illustrative customer relationship in the long term. So looking for that too, and folks who can be strategic about picking those people early on.
Yeah, and on that point, we see so many companies that will put logos on their website or on their pitch decks that we know people at those companies. So we call, hey, how do you like it? It's like, oh, we use this? I didn't know we used this. Or no, we did it. So don't do that. I know it comes from a good intention or something like that, but the way that you represent, don't overstate that side, because it really reduces confidence.
And it's so easy to check.
So easy to check.
Yeah.
So easy to check.
How do you feel about things which were more like quick wins versus bigger swings? So you said about customer love, customer traction. We've seen some point solutions that have got some good early traction, but it's unclear what the big opportunity is after that. We've seen some other companies that are going for a bigger platform play. It's going to take longer to build, but maybe they can own more of the market eventually. So where is your appetite for kind of quick wins, showing early traction and revenue versus no, keep your eyes on the prize of a much bigger platform play? Maybe Renata, start with you on that one.
Oh, we're here to win the decade on the moment. We tell our LPs, we're not a hype fund. It's right there. We're here to back things in markets that matter, companies that need to exist, not companies that can't exist, right? There's a difference. And we're here to make great returns for our LPs and to create society value and employee value. So I think the question for us is more one, What is the timeline that your technology can evolve? Is that a timeline that matches a VC fundable type of return? One. Two is what's the capital that is going to take? And I remember, because I've been investing in frontier technology for over a decade. And I remember having conversations, especially like scientists that make amazing scientific discoveries. And they're so excited, like, look at the breakthrough I had. But then when you kind of take the step back and say, okay, what is the market's ability to give you financial credit for this amazing breakthrough? And a lot of the times the answer wasn't there, right? So can you also get the financial unlock or the capital required for you to break the milestones that you need? So that's the stuff we care about. This timeline, how much it's going to take you to get there, and can you unlock the next levels the right way? We have patience, like meaningful things, big things. Like that's what we're here to do.
I think one of the things that investors are looking for is just your velocity of execution. If you are your path to market does take longer. It's not something that you can vibe code really quickly and you show that incredible customer traction week over week. It takes longer because you're building a broader platform that's just harder. We were just looking at a company that's doing EHR software for independent practices. And so it's a complicated platform to build, but so they weren't live yet, but seeing how much they were able to build in a really short amount of time over the course of a few months was really impressive. And their design partners were loving it. So they had that customer feedback, even though it hadn't necessarily translated to, the month over month sales that you're now hearing in the ecosystem, how quickly certain companies are growing. But so this is going to take them a little longer to go out. But once they're there and they can do a rip and replace because they have that much better AI native system, they can build a really massive business and with really kind of sticky revenue. So again, that goes back to that durability of revenue piece. That is another critical thing that investors are thinking about. But yeah, the velocity of execution is just really critical to be able to demonstrate, in whatever way that means for your business.
Yeah, I think as investors, it's our job to know what sort of normal would be for an industry and then know what a beat looks like in a way. We have a company that has, it's working on legacy energy data stuff. And some of their sales cycles are 4 years long, insane. And if we didn't know that, we'd be incredibly disturbed by how things are going. But they're moving at a way that outpaces what we've been conditioned to think is normal in that industry. So that's encouraging. We share a portfolio company that Carl and his team worked on that's in the spatial AI for retail applications space. Retail sales cycles, grocery, major big box, that sort of retail cycles are also notoriously quite slow. We knew that going in. We still thought the founder was quite interesting. The space was quite interesting. He's blown through our expectations in terms of execution and, has contracts that we imagined would take him, years to ink. And so it goes back to team again, feeling like you have people who are beating the odds in terms of velocity that's normal, but also having reasonable expectations about what's possible. We have a company that will go public next year. We invested in it 12 years ago. It's pivoted 3 times. The team has always been amazing. The business has changed. They're doing $1 billion in revenue. God willing, it'll just be a fabulous, fabulous debut. But if we'd given up on them or become impatient over the course of this time, we wouldn't be in this position, which will ideally be quite exciting next year.
But speaking of velocity, one thing which scares me or would scare me if I was in your shoes or if I was a founder is the idea that we have these very big behemoth AI companies, Anthropic, OpenAI, etc., that are funded up the wazoo. And the idea is that they could quickly and easily just replicate anyone's product. And we've seen that sometimes too already. So how do you think about defensibility? How do you both have that risk appetite to invest in something for the long term? But how do you guard against the possibility one of these big companies could just come and roll out a copycat or a very similar product, and with the brands and with the distribution, it could just do a better job, and then your investment could go down to zero. So how do you think about being bold and visionary while also managing the risk of obsolescence of the product? So, yeah.
Yeah, so for me, for us, the answer for now in this market where things are is vertical. Because it is true that everything that is probably like horizontal, broad strokes, those platforms are going to very quickly get there. And then they also have the distribution advantage. But everything that is horizontal, where owning the workflow gives you access to unique data that gives you ability to train your own model, that is going to give you defensibility. And we have things like that in structural engineering and teleradiology and aerospace and other industrial automation verticals. And then when we think of horizontal, the way that we are approaching horizontal is not on the particular app layer. We're going a little bit under the hood and say, what can these enterprises use that will help them adopt more AI? And as AI get better, the need for these products increases. So we invested in a company called Overmind that does predictive code generations or change blast radius analysis. And before you push out a code change, it runs through your whole infrastructure and tells you, is this a high risk code change, low risk, and what is the probable area in your infra that is going to break if you go ahead like that. That allows big customers to go and say, okay, I'm going to use more generative AI to create code. I'm going to use more of that stuff because now I have guardrails and better QC. Overmind only gets more important as those things get better. So we like that place. And it's not going to live, in those platforms that Carl talked about. Or, free play that helps enterprises like Cisco, Chime, et cetera, figure out, okay, what model do we use? And they're multiplayer inside the company. So HR uses it, sales uses it, et cetera. That gives these enterprise confidence to push more AI products and AI apps. Again, it's not going to live in one model. They may have ability for you to figure out QC and how their model is performing, but they're not going to say, oh no, use the other one instead for this app, because that's never going to be the case, right? So those are the ways that we're thinking now in this market, in this moment, for horizontal stuff, the on-ramp.
Yeah, I definitely agree on the proprietary data being a key piece of defensibility. And then also in vertical. I mean, that's partly why we are sector focused. We love somewhat esoteric, potentially niche, but sneakily large markets that are simply like not going to be on the radar of some of the incumbents, or just don't even have like incumbent technology players. For example, we're investors in a company that's doing compliance software, like AI native compliance software for the agriculture industry, which is historically pretty stodgy, but massive market. And they're like growing incredibly quickly. And that's just not going to be an area. I mean, you never say never because they're pretty much in everything these days, but there's not necessarily like large incumbent technology players in that space. And so they're really well suited to build a big business in that sector. So that's certainly one of the ways that we think that you can have defensibility and by choosing your lane wisely. Agree.
Yeah?
Yeah.
Let's do some sort of rapid fire questions. What's a red flag that would turn you off of a pitch if you read it in your inbox? Like, what's something which is an instant pass, instant no for you?
Oh, the vertical revenue hockey stick in a short period of time.
I thought you had to have that, no?
No.
Any other red flag?
Yeah, the generally squishy revenue metrics that I think so many founders right now think make sense.
Like the wrong metric, or it's a projection that's too optimistic, or?
Yeah, that, and also like extrapolating supposed ARR from a good week.
Right.
I can't put that in a deck and think we'll take that seriously.
And please don't call run rate ARR. Like, please don't mix up the two.
Yeah.
Any red flags for you, Leshika?
Not like not having a strong like why me, like why am I passionate about this? Where sometimes we meet teams where it's almost like an intellectual exercise where it's like, oh well, I did this McKinsey style market mapping and I've identified like this is the area that I'm want to build in. And it's like, no, but what is your unique advantage? Like did you like have to run through so many walls? It's like, you guys know you're all builders. I mean, it is hard. And so you really have to be passionate about the problem that you're solving, have to have like a why me that comes from like really like deep from within, and ideally some sort of unique advantage to be building in the market. Like you personally there's some sort of distribution advantage or something that you and your team have uniquely see that other teams don't. But just has to be very clear and be authentic in that why me as well.
Yeah, when we meet founders who say, you know, I was either going to go join like X place or I'm building this, we're seeing less of that, I think, than we used to. I think there was a moment in like ZERP universe where that was a really fun option for smart, engaged people. Because that signals a lot of things. And potentially it signals that if somebody comes to you with an acquisition offer in 8 months for $30 million, that would be quite compelling. And as a human, I understand why that would be compelling, but that's not a potential venture outcome for us. So certain things like that signal that you're not in it the way we would need you to be forever and ever.
Okay, my final quick fire question before we open it up for Q&A is, does everyone have to have an AI story? You know, we certainly see companies that kind of aren't AI companies that then try and position themselves as AI companies, or other companies that are using different technologies, whether it be ML or something else. And so they're framing that as AI because they believe that you guys need to have an AI story. So is that true? What if you're not a real AI company? What should they do?
I think that investors can really sniff out when it's not, when you're just like slapping on an AI story and it's not core to your offering. And I think it's okay if it's not core. I mean, you're going to be using AI tools, and so if you're building software, you're going to be using AI to build, and there's lots of ways that it can expedite, your company building and your path to market. I think for us, again, given our sectors, we have plenty of AI companies, but we proactively have some non-AI investments, especially in areas like healthcare. We proactively invested in a few tech-enabled services companies. There's certain industries, like, for example, we have a company that's doing like palliative care. It's really helpful to have a human in the loop. That's a space where human empathy, like, really necessary. And so you can build a really big business with good margins in some of those spaces. So when we think about like our broader portfolio, we like to have some companies like that too, from a diversification standpoint. So yeah, if it's not truly core to what you're doing, like I wouldn't just, throw AI somewhere. Yeah, exactly.
Don't build a company for investors, build a company for your customers, find markets that are growing, that are hopefully big, and fund them in an appropriate way that allows you to build what you want to build. If you're taking VC dollars, you need to show the path to $1 billion, 10 billion, whatever it is, depending on who you're raised from, and that's the route. Many routes to build a company. Don't build a company for investors.
Great advice. So let's hand it over to the crowd then. So, okay, wow, a couple of. I'm going to have to give you most enthusiastic member of the crowd. So I'll give the microphone to you, please. What's your question? Oh, welcome.
They were AI generated.
Generated question.
I'm Amin. I'm founder of Resilience AI, Wellness and Observation Space. The question is, as we talked about, right, your startup is sometimes one feature away for a big monitor to replicate and do it, right? So when we talked about being able to pivot, teams have to be able to pivot. So what do you look for in a team that says, hey, this team can perceive it as a pivot? What is that signal that you look for in this to understand?
For me, it's a combination of velocity of experimentation and also being very clear of knowing when to pull the plug. Like, what are the guardrails to quit, or like having had experience, say, I tried this, I was hoping to see XYZ, didn't pan out, so I moved to another thing. Because it's very easy to stay wedded to our ideas, or you're 80% there where you want it to be and you just keep going. It's very human. So nimbleness means experimenting, doing the right bets, not being fickle, which is the opposite side of the coin, but knowing how and when to quit.
Okay, what else? All right, second row. Oh, give it to him. Very generous. Victor?
Hi, thanks a lot for the great panel. It was a pleasure listening to you. I have a question in regards to the outcomes that you really see when committing to a venture. What is the ideal outcome for all of you? I understand it depends on investment pieces, but they'd be just interested to hear a little about that. Especially me coming out of Switzerland for a visit here today, we have a completely different landscape of the outcomes that it's, kind of considered to be the standard in the venture industry. So it'll be interesting to thanks.
Yeah, it depends on the fund model, to your point. We are a seed fund. Our latest fund is $200 million. Without getting too into the math, we need several 10-digit outcomes and a nice handful of 9-digit outcomes, and then a bunch of zeros. And that's okay. That's totally baked in. But everyone should be going for like something starting with a B is how we have to think about it.
I mean, depending on your fund size, like investors are underwriting for at least a 10x for any given investment. And so this is why, thinking carefully about your cap table and the types of investors you're selecting, and what their incentives are, and making sure that you're aligned with how you want to grow the business is just really important. I think now we have larger and larger funds than ever before. I mean, there's like $10, $20 billion funds now. The outcomes that we're also in a market where there's, potentially $1 trillion companies. And so it's like, you can build really big businesses now, but there's only so many of those, right? Like there's far more, exits and M&A at, the billion or even like sub-billion. And if you're with a smaller fund, a billion or sub-billion outcome can still be really great for your early investors and for founders. And so you really want to kind of understand, again, like investors' fund size, their incentives, what they're underwriting as you think about your capitalization strategy.
Going to go over to this side of the room. I think you had your hands up. Yeah?
Have you guys ever invested in a non-technical founder? Without like a solo founder, and were they just a good CTOs there? And if you haven't done that, did you ever do that? Like, what would be the reason for you to want to do that?
Yeah, we've done it. But again, we're generalist and we look at a lot of consumer stuff. And so we definitely have founders who are very product oriented, tons of brand DNA, all of those sorts of things. And it really depends on the sort of business, though. We wouldn't do it for many sectors. It wouldn't make sense. Nor would that person come to us. That wouldn't feel right to anyone, probably. But in certain areas, absolutely, we do it all the time.
Does AI lower the bar to have more non-technical founders coming in?
I think it's very hard to fund somebody who doesn't have a technical lead on the team, right? That I think that's the hard line. And then when you go and you see that person doesn't need to be a co-founder, but then you look at, okay, relevant experience and are they rightfully incentivized?
There's another one over here. You were lobbying here, Joel. So go for it.
Hi, I'm Joel, better CEO Hotline, the kind of creating streaming AI. Question is, what kind of trends are popping up right now in the pitches that you're getting in the industry as it moves forward? What sounds exciting? What's new? Like, what is it that we as founders should be kind of looking at when it comes to functionality that investors like yourselves are looking for?
Voice. There was like there's a ton in voice, like in health. A few months ago, there was about a dozen companies doing using voice for scheduling. But then it's kind of like, all right, the trends question is tricky because then it probably means like there's going to be many players like moving into a space at any given point. And so it just has to come back to what's your, like, why are you building? Like, what's your unique advantage? And ideally it's something that's differentiated. It's kind of like outside of those trends. Because you don't want to be building in a space where there's a dozen people. Or it's like a company that has something unique. But for example, like we did not end up investing in any of those companies because it's really hard to see what the differentiation was.
Yeah. We have like 4 things in kitchen, restaurant, tech, universe. So I'm curious to hear what you guys are building. But yeah, I would say, yes, we saw tons of voice things and we saw tons in like search and like modern ad stuff, which we definitely need, but we haven't done one yet because nothing stood out. And huge
agent coordination.
Yeah.
compliance. Yeah.
Agents for verticals.
Right. Yeah. Yep.
Like browser-based AI too. Yeah.
I've got a couple of questions from Slido, so thanks for sending those in. First one is, how do you evaluate founding teams? A lot of conversation around focus on the founder. So what are you looking for when you look at that founder and founding team? What are you looking for there? How do you make that evaluation? Emily, you're smiling.
I'm just like, how much time do you, like, that's the whole ball game.
Is that the secret sauce?
No, it's just like all we do all day, pretty much. You know,
Do you have metrics? Like, do you have a checklist? How does it work?
not at our stage. I think it's so much about feel. It's so much about, do you believe this person in when they say why me and why now, and they have differentiated experience that's giving them the best right to win they can have, knowing that a million things will happen that will make that challenging. I always like seeing people who've worked together in the past in some capacity, which is quite common, obviously, but the idea that it's like co-founder for hire, that's often a weird flag. It's not always, but I love when somebody like spent 5 years together at Toast and then they went and did their own thing and then they reconnected because they were each the smartest person they loved working with in the past. That's always fun. But every team is different. I mean, we really see every combination and do lots of solo founders too, but there's no one right combination for us.
And you should also know, I don't know if this is always clear to founders, but investors are like back channeling the hell out of you. So they're like, any kind of mutual connections or folks or places you've worked in the past where they might know somebody, they're absolutely calling your previous companies and asking. You'll probably give them formal references as part of the process. They wouldn't call if you're like still at a company you haven't left yet. You know, they're not calling like your manager before you've left to start your company, but certainly they're going to be trying to triangulate to understand your grit, your resilience, your velocity of execution, how passionate you are about building in this space, all the things that they're really trying to gauge. It's helpful to know from folks who've worked with you in the past what those qualities look like.
Sometimes for us, we'll reference a founder with someone they used to work for. And if the person says, yeah, they were good, we're like, oh, okay. That's a no. Not always, but if it's like, yes, totally solid, we're like, okay, that's great. They are a fabulous employee of a fabulous thing. It's so different to have to.
Yeah. And sometimes it's like, it can be, if it is like a manager, sometimes it's like, it can be polarizing, like especially a back channel where they weren't the best fit, because if you have entrepreneurial DNA, oftentimes like the big tech company is probably not the best fit. So you really have to like read between the lines. Yeah. It's not, you don't want someone who's just like, I'm going to climb up the ladder here at like the 20 years. Like, it's a different, when you're a founder, like you can't stand to go down that path. And so there's some nuance to it for sure.
Okay. Who would like to have the final question? Well, your hand's up. Okay. Is it a good one?
And you're back.
Sure.
Way to encourage them, Carl.
I'm currently in the education space, and I just wanted to know, like, what are your guys' thoughts, like, the startups that are business to consumer, or business to business, or business to government, like me, like, how appealing are those to you? And do you have any other insight for education technology?
I think, it's not unique to education, but one dynamic in education is usually the person who uses the product, benefits from the product, maybe not necessarily the person who pays for the product. So that multi-agency aligning those dominoes to make sure that you're checking all those stakeholders. Duolingo is a very valuable company and continues to do more and more. They prove that consumers will pay for things. So you don't need necessarily to sell to districts or government or et cetera. But I think understanding the channel, understanding how to align results, and making sure that those stakeholders are all happy. Because if the payer benefits, but there's no usage, right? Like, it doesn't stick. More complicated than that, but trying to give you some 1 minute tidbit.
Well, let's wrap there. I mean, I would love to keep on going, but people have places to go, people to meet. So I'm going to wrap up with a couple of housekeeping items. So for one, we have these silly hats that we made that we're pretty proud of. If you'd like one, please post about this panel and mention us, presentation mode, and you can get one of these special hat GPT. This gentleman has one, Daniel. Wave it in the air. If you like one of those hats, please grab one. Second of all, for people who are interested in working on their pitch, we have a founder bootcamp. It's coming up in San Francisco in October for people who want to practice some of the principles that we learned today and you want to be able to improve the chances of getting funded. Please reach out to us. It's bootcamp@presentationmode.co. A couple of thank yous. I want to first of all thank Imogen. Imogen's right there. She actually organized this whole event. So thank you, Imogen. And of course, thank you to our wonderful panelists, Renata, Leshika, Emily. Thank you all so much. Wonderful insight. Really appreciate you. And thank you all for coming as well, of course, and enjoy the rest of Tech Week.
All right, fine.